So this is September 2021, question 1B. Proxmax Enterprises, a resident company that deals in asset leasing. For the year ended 31st December, the company reported the following transactions. 1, assets leased in the course of the year: manufacturing machinery to Pendo Limited at an annual lease, cost of $4,200,000. 10 saloon cars to Samtech Tours for 4 months at $40,000 each per month. At the end of the 4 months, Samtech Tours returned 4 saloon cars and renewed the lease for the others for an additional 3 months at a discounted pay by 10%. 5 lorries to Arc Limited at an annual lease of $800,000 per lorry. However, the lease was terminated after 9 months after it was found that the lorries had serious mechanical problems. 6 pickup vehicles to Fahari Limited in Rwanda for $200,000 per month for the whole year. Computers to Digitech Limited at an annual lease of $200,000. Proxmax Enterprises incurred the following expenditure in the course of the year. So purchase of manufacturing machine for leasing, installation costs and repairs of the manufacturing machine before use, purchase of 2 saloon cars each of $2,100,000, purchase of a lorry of 4 tons, admin expenses, legal expenses of $240,000, out of which $100,000 was in respect of defense of an alleged breach of lease agreement, marketing costs of $300,000, with $80,000 being for erection of a billboard for advertising. The following additional information was provided. A pickup vehicle was written down value as of January was $420,000 sold upon expiry of the lease in 2020 for $580,000. The written down values of the following assets as of January were: so we had lorries of 4 tons, computers, and then you have motor vehicles, furniture. Other incomes of Proxmax Enterprises include interest income from Ufanisi deposit, taking microfinance, dividend income from Wananchi Sacco, royalties income of $400,000 net. Corporate tax rate applicable during the year was 25%. Of course, you can't use 25. 25 was in 2020. To avoid confusion, we must consistently use 30% because that would be the rate that will apply to our exam. So we must use that. Required the adjusted taxable income, and it's not adjusted because we are not adjusting. We've not been provided with a statement. And we're just preparing a statement of taxable income and tax payable for Proxmax Enterprises for the year. So let's prepare the statement of taxable income. So the company is called Proxmax. Proxmax Limited, so the enterprises. And you're preparing a statement. Of taxable profit or loss. So we get the income items, then we'll only lessen the allowable expenses. The income of Oxmax would come out of leasing of assets. So in note 1 wanasema the lease manufacturing machinery to Pendo. So the lessee is called Pendo. So Pendo Limited is the lessee, and they leased out machinery, Pendo Limited, and the machinery was leased for 4,200,000. So that's the income they are expecting. So they're expecting 4,200,000. $4,200,000 is the income. Ten saloon cars to Samtech. So the other is called Samtech. Samtech. They lease 10 saloon cars. The terms are 10 saloon cars for 4 months at 40,000 each. So 10 saloon cars, 40,000 each for 4 months. So that should be 1,600. At the end of the 4 months, Samtech returned 4 cars. So Samtech returns 4, so they are left with 6 saloon cars. And the terms, and renewed the lease for the others for an additional 3 months at a discounted pay by 10%. So 6 cars, now at a discount, so 90% of 40, but for 3 months only. So 90%. So we discount it by 10%, so they only pay 90%. So 648. Then 5 lorries to Earth Limited. So Earth Limited is the lessee. They lease 5 lorries. At an annual of 800 per lorry. However, the lease was terminated after 9 months. It was found that the lorries had serious mechanical problems. So 5 lorries, the annual payment would have been 800, but we do an apportionment. 9 months out of 12, because the lease was terminated after 9 months. This would be 3,000. Six pickup vehicles to Fahari Limited in Rwanda. So Fahari Limited. To 6 pickup vehicles to Fahari, 200 per month for the whole year. So 200 per month for the whole year, 12 months. The 2,400,000. Computers to Digitech Limited. Computers to Digitech Limited at an annual lease of 200. Then there's some information in note number 3. The following additional information was provided. A pickup vehicle whose written down value as of January was 420 was sold upon expiry of the lease in 2020 for 580. So in this business, their stock are capital items. So if you sell, ni kama umeuza stock. So it's not a capital gain, but an income. So there is gain on disposal. On disposal, is gain on disposal of pickup. It's not a capital gain because that's what they deal with. So you take 580, the sales proceeds, minus the written down value of 420. There's a gain of 160. This will give us our income items. Then we lessen allowed expenses. So we'll first get normal revenue expenditures. Then we'll also be able to bring in the investment allowances for the assets that were acquired. So if you look at note 2, we have admin expenses of 2,400,000. So admin expenses of 2,400,000. So get that. We also have legal expenses of 240, out of which 100 was in respect of defense of an alleged breach. So that breach is not yet concluded. It's still an allegation. So it's a matter that has not been determined as yet. So you cannot say outright that they are guilty of breach. They'll be guilty after the allegation has either been proved to be true, or so it's something that is still subject to determination. So we cannot disallow 100 as such. We'll just say legal expenses, and we have 240. Legal expenses is 240. Marketing cost is 300 with 80 for being erection of a billboard. So we'll disallow the 80 for billboard and for marketing expenses. So marketing expenses will have 300, but we lessen the 80, so we have 220 for marketing expenses. Well, the rest of the items will involve assets. So we want to claim investment allowances. So investment allowances, they purchased a manufacturing machine for 6 million. Then they paid incidental costs of installation and repairs before it is used of another 240. So you add those two so that you have manufacturing machine, manufacturing machinery. So you take 6240 plus the incidental cost. We are required to provide for 50% in the first year. 50% the machine is put into use. In the first year, you claim 50%. So 50% here will be 3120 for the machine. Then there are 2 saloon cars. But for the 2 saloon cars, if you look at note 3, we also have written down values for motor vehicles. So saloon cars. We'll start with the opening balance at the beginning of the year. In note 3, for motor vehicles is 1,200,000. That's the opening balance. Then we add these ones that were purchased. 2 saloon cars purchased at, so there are 2 cars at 4.2. So each is 2.1. So it doesn't violate the rule of 3 million. So the maximum each should qualify for is 3 million. So each is 2.1. So 4.2 is for 2 vehicles, not just 1 vehicle. We don't have any disposal. The rate for motor vehicles is 25%. So it will be 25% of 5.4. 25% is 1350. That is for saloon cars. Then there's lorries. So again, lorries. We'll start with the opening balance in note number 3. Lorries of 4 tons, opening balance is 4 million. Then you come down back to note 2. There's purchase of lorry of 4 tons of an additional 1.8. So you add 1.8. So the rate for lorries is 25%. So we get 25% of 5.8. And 25% is 1450. That is lorry. Alafu tuko na hiyo billboard. So we also have a billboard. Billboard ni 80. Unachukua 10% ya 80 na 10% ni 8. Hiyo ni a billboard. But there are additional assets we need to bring in 3. Kuna computers. Wanasema the written down value for computers ni 420. Unachukua 25% of that. Nafikiri ni 105. That's for computers. Motor vehicles tulimaliza, then kuna furniture. So furniture written down value is 180. You take 10% of 180. 10% is 18. So with that, we can get the income from leasing before we look for any other incomes. So we work out incomes one source at a time. So the source here is leasing. So from leasing, we can have this. So the result here, total income is 12,208. $89.11. $32.97. This is taxable. So from leasing, we have $32.97. Then we can add the other sources of income. So to get the other sources, we look at the bottom of note number 3. Wanasema other incomes of Oxmax Limited included interest income from Ufanisi deposit taking microfinance. So interest from interest income is taxed twice. It's called non-qualifying interest. Interest from a bank or any of the financial institutions. Withholding tax is 15%. That's why the exam is saying net. So if 15% have been deducted, then what is left is 85%. So you can work backwards and say if 85% is 240, about 100%. It will be 240 divided by 85 times 100 to get the initial amount. So interest income from ufanisi. So from ufanisi, you pick the 240. This is equivalent to 85%. You divide by 85, you multiply by 100 to get the gross of the initial amount. The gross would be 282.353. So come and say 282.353. Then there is dividend from Wananchi Sacco. Now, a Sacco is a limited company, so withholding tax of 5% is the final tax. The only dividend we tax twice is that of the farmers cooperative. Wakulima huko wa mashinani, so it could be a dairy cooperative or dealing in crops. Those are the ones we tax twice. So you ignore the dividend from Wananchi Sacco. The withholding tax of 5% is the final tax. Then there are royalties. Royalties are also net. Withholding tax on royalties is 5%. So what we have is 95%. Kama washatoa 5% wanabakisha 95. So to get the gross royalties, itachukua 400 and divide by 95 times 100. So we'll come and say royalties. Royalties income. It will be 400. You divide by 95 because it's 95%. You multiply by 100. So 400 divided by 95 because they are already deducted 5%. So you get 421.053. This is 421.053. Then we add everything to get the total taxable income. So total taxable income would just be an addition for the three sources of income will be added. Yes.
How are you knowing it's 95 and 85%?
I said there is a withholding tax rate. I said the withholding tax rate on royalties is 5%. That's why what is left is 95. There's a withholding tax rate on interest of 15%. That's why what is left is 85. So we add this to get the total taxable income. Sorry. Yes? 4,001. So 4,001.406. 4,001.406 is our total taxable income. 4,001.406 is our total taxable income. Then you get corporation tax. The examiner wanted tax. So 4,001.406, I will get 30% of that. You're getting a different result. It's 4,000. Just 4,000? Just 4,000. 0.406. So it's 4,000.
406.
30% of that should give us 1.2, 121.8. Then you must lessen the withholding taxes. So there's interest from Ufanisi Cooperative. So this is 282, 353. You multiply interest by 15%, and that would be 42, 353. Deduct that. Then there is royalties. So from royalties you get 421, 253, you multiply by 5% withholding tax. And withholding tax is 21. You get corporation tax payable. Then we look at one last question on leasing, and this is hire purchase. I think it's question 3 of the same sitting, September 2021. Yeah, question 3 is called credit lenders. There's a question 3 of that same September of being able to credit lenders. September 2021, question 3B, it says the following information was presented to you by the management of Credit Lenders Limited as at 31st December 2020. The company deals in the sale of manufacturing machines on hire purchase terms. 1, the company purchased the machines at 600,000 each. 2, the hire purchase price per unit comprises of a deposit of 160,000, and 8 quarterly installments of 80,000. Cash price per unit is 700,000. During the year ended, the company sold 4,080 manufacturing machines, of which collections of 569,600 were received at the year end. During the year, the company repossessed 80 machines which had been sold earlier in the year. The customer had already paid 6,400,000 on the units, which was included in the total cash collections for the year. The repossessed units were valued at 520,000 each at the year end. Expenses incurred in the course of the year included rent expenses, legal expenses, of which 320,000 were in respect of defense against illegal importation of a machine, advertising and marketing, salaries and management expenses, purchase of a mobile forklift. Other incomes included royalties of 289,750 net of withholding tax, dividend from Uzima Cooperative Society 120,000 net of withholding tax. 7. The Revenue Authority has reached an agreement with the company whereby profit for tax purposes will be determined on the basis of proportionate cash collected from the customers for the year sales, required taxable profit or loss for credit lenders limited for the year end. So we'll prepare a statement of taxable profit or loss